the TVIX, the SHVIX. And so I've done a couple TVIX videos, but this one I would imagine is going to be a hot topic now because we just had an explosion in the VIX. So the TVIX is a volatility index that is a 2x, so you get more exaggerated moves on the upside. And I just wanted to take a look at the TVIX versus the VIX, and then another secret trick that I'll show you at the end, because I've been long volatility since back in here, and I have not been holding the TVIX long. I do not like that trade. I'll tell you what I've been doing for long volatility, and you can look at the charts and see what they actually look like. And so yeah, you can see here that TVIX, can do crazy exaggerated moves up, and let's look at it versus the VIX. So you can see kind of the height here, and this huge volatility explosion that we've gotten has taken the volatility not even to the height of the previous peak here on the TVIX. And this has to do with the structure of a 2x kind of levered fund, where over time the volatility just kind of eats down the value of the of the fund. And it's an ETN, so it's an exchange traded note from Credit Suisse, which means that there's not anything actually backing it. It's just a debt note from Credit Suisse. So with ETNs, you have a little bit of counterparty risk with the N, more than the fund that actually has some physical thing backing it. And then with the 2x levered, you get more dramatic moves, but you also lose a little bit more in the compounding over time. And let's switch over to the VIX, which is not a 2x, and you can see where the VIX broke out to. Here, it's not below this one, it's above the two previous peaks, almost to this one. So the VIX popped up into this range where you saw the TVIX only came up to like kind of this height. So that's kind of the difference with a levered and a non-levered kind of fund, is the levered fund will lose percentages over time. And that's why I don't hold I don't hold the VIX long either, because it's still a fund that that kind of works its way down over time, but it doesn't do it as much as TVIX does. And if you go look up the TVIX, it tells you it's made for day trading. But you're not supposed to be holding TVIX long term. It just says that in the description. Because every night when the compounding math happens, it just kind of loses percentages. But if you use it during the day for day trading, none of that really matters. And this is similar to looking at like the UCO or the USO with oil, those funds where you get the kind of the contango and the compounding just kind of eating away at percentages, and it just trends down more than the underlying assets do. But there's a different one here, and this is how I go long vol, and I haven't been holding the VIX or the TVIX long, but there's one called SVXY, and this is a short VIX, and so it's upside down. And what you can see here is this huge, volatility blast that we got with, the big liquidation sell-off at the beginning of this crash. The VIX and the TVIX blew up high. This one blew up down. It's upside down because it's a short VIX. But you can see here that the compounding on this one is upside down. So it just trends down. So as far as these kind of ETNs and ETFs go, I prefer to short them than go long on them, because of the structure of the compounding. It's in your favor if you're shorting it, but I want to go long volatility because I think that, well, this would happen. I think it's gonna go nuts, but what I've done is shorted this one. I short the short VIX, and that way you're long volatility, but the compounding's in your favor, where these moves up get kind of stunted by the compounding, but the moves down don't. And what you can see here on the SVXY, and this is not levered, It's just an inverse VIX, but you can see where the move came to. The move went past all of the peaks, absolutely all of them, except for the very bottom one. And look how close it even got to that one. Yeah, so I mean, if you get on the normal VIX, like look, it didn't even get anywhere close to the peak. I mean, it has to go triple or 4 times where it is now to get back to this peak, right? And that's because you're fighting against the compounding. But with the SVXY, that compounding is helping you. Those percentages that you're losing when you're shorting it are helping you. And so the VIX has been working its way to lower volatility this whole time. But look, the SVXY has barely pushed up because the compounding is fighting against that increase. And now when you get a breakdown, look how far it breaks down, almost to the peak. And so, like, if the VIX were to break, like, go crazy, the way up to where that peak was on the VIX, like, this thing could break way past the peak on this. And that's just the structure of these, of these ETNs or ETFs. And so, yeah, that's the trade that I'm doing now, is looking at this, and it ended up, like the TVIX, holding the TVIX long, you're hardly even up. But shorting this one from here to here is the same move in volatility, but look at the difference in the shape of the chart. I mean, this is a big win shorting it from here to here, but if you look at like TVIX on the same timeline, I don't even know if it's ahead. It probably is, but just barely. Shorting it from here to here, look, it's almost even, and it's nowhere near the peak, that's for sure. So yeah, that's just a look at the structure of these, and how to get the structure of them in your favor is to basically only short ETFs and ETNs. I mean, and if you want to go long, and this is not investment advice, but short the short ETF, and then you get the compounding stuff in your favor. And that only matters if you're holding it long term. You get like a little advantage holding it short long term. But you want to get the trend right. I mean, it doesn't help you to, short the thing at like this. If volatility is going to go up, you don't want to be shorting like the VIX. But if volatility is going to go up, then you can short the short VIX, and that's how you can go long volatility, and not be fighting against the structure of the ETF. Yeah, and so this is a similar video to one that I've done before, but I'm sure people are going to be looking up the TVIX like crazy, because the TVIX is so popular because it's a 2x, and yeah, and the structure of that thing is just not helping most people in the way that they think it is, and this is how I do it when I want to short, when I want to go long volatility, is short this one, and I think there's some other short volatility ones, but this is the easiest one to trade that has the most trading volume, and I have some puts on this out to whatever, October or September. I have some different ones, but yeah, I'll be looking at the trading action right now to see. Let me go to the S&P and take a look at where the VIX went nuts. And basically, there's two spots where the VIX went nuts. There's a consolidation zone right here where it did a wobble reversal, and the VIX went nuts right there on this wobble. And here's a big one where it did a huge wobbling consolidation reversal, and that is where the VIX went absolutely crazy. It was right in this zone where this consolidation is. So as far as the VIX goes, like, this kind of direct move down is not the type of shape that you're looking for a super high volatility play. Like, what you really want to see, I mean, you do want to see it go down because that will make the VIX go up, but what you really want to see is a wobbling consolidation zone and the VIX would blow up, and then you can trade out of the VIX positions, and then you get your swing to the upside on the normal chart, like we did back here. And that's kind of the ideal scenario for going long volatility, is this kind of crash, but then a high wobbling consolidation reversal, and you get a out of control VIX reading during the consolidation at the bottom of a crash. And so yeah, so for long vol, that's really what the long vol bet is. You're betting on a down move with a consolidation. Like that's how you win with a long vol play. And that could happen again here, because this big liquidation move here, this is plenty big of a liquidation to start kind of a bear market. But now that we've swung all the way back up here, and we've gotten all the way back up to this higher level trend line and back tested it, well, now we're not really in a position where we've done much of a bear market beginning. Like, in order for this to be a real bear market, like this thing needs to rip again. And that, if it's going to happen, should happen sooner than later. And so, and it doesn't have, this is really deep. Like it doesn't have to get down this far. It just has to get below, it just has to get below this one. That's really all it has to do, is get below this trend line and probably break it, back test it, and then you'll do a consolidation move. That's what you'd be looking for as a long vol kind of bear market play. And we'll see here pretty soon. I mean, we should see some interesting stuff today because the volatility is so high. We might get some wild swings, but we just want to see if we're going to be testing this line again, like a double test, or in the bull market case, if you can just run out of here and use this as support. And then in the bear market case, whether we test this once or twice, what you're looking for in the bear market case is to break this one and back test it. And then for volatility, you want that consolidation. And so that is the look for the TVIX and the volatility. And the bear market fundamentals, if you look at financials, you look at the VIX, we have bear market fundamental stuff. I mean, obviously we're in a recession. We just got another unemployment number, 1.2 million more unemployment claims that just came in. Like people are still applying for unemployment like crazy. And the financials broke down really hard. I guess largely that would have to do with the interest rates forecasted to say around 0 for the next year and a half or something like that. Is really bad for financials. Financials just don't make money with 0 interest rates. And I mean, we've seen that in Europe. Like the international banks have been doing awful with negative interest rates over the last 10 years or something like that. But American banks have had positive interest rates. But now if the American interest rates are around 0 or maybe going to go negative, that's brutal for American financials, and that's a bear market indicator. And then the small caps and the financials are not doing stock buybacks, and they have the solvency risk, and those are both rejected out of the moving average back into bear territory. And so, I mean, you have things like Infotech and NASDAQ and stuff like blowing up, like up in bull market territory, nowhere near this moving average. And then you have more fundamental stuff like the financials and the small caps down here, rejected back into bear market territory. And the S&P has popped off right off of the moving average, like right on it. It's pretty wild. And not going into bear market territory yet. It's still on the bull side. And so that's the thing to watch for the next, well, let's just see what happens today. I mean, if we break down again today on the S&P, that would be a really bearish indicator. And I don't know if I should trade out of some vol positions now. And see if we get back up here, because I feel like a double test of this line is likely, even in the bear case where we break down here. I think a double test of that line is likely. So I don't know. I don't know what I'm doing. I'm not giving investment advice. Just kind of the idea of how to play different things that might happen, and that's the long vol play. Is I mean, obviously you're looking for down, but I think what most people don't understand is the structure of the ETFs. If you want to hold them longer term, are fighting against you, and it's way better to short them. And you can short a short in order to actually go long, but get that in your favor. And then the consolidation at the bottom of a down move is really, really where the volatility goes nuts. Um, and yeah, so so the long vol play, I guess, really is expecting another liquidation move down, rather than just the move down. And maybe that's foolish because the Fed has restructured the whole freaking world economic system now, where there's swap lines in place and four-letter programs to get liquidity to all of the international banks. And so I don't know if another liquidity move is going to happen or not. Um, we'll see. Yeah, we'll see soon if we get another kind of liquidity thing. Um, but but of course, like, they're blaming absolutely everything on the virus and not on the financial system freaking grinding to a halt. And I mean, that's what was happening. That started in September, and this liquidation is not a viral liquidation. This is an economic financial system. Um, the liquidity completely dried up and collapsed across the whole worldwide system. This is a liquidation move in the international financial system. It has zero to do with the virus. And but this kind of stuff, over the next couple of years, like the small caps, is going to have a whole lot to do with these lockdowns, because companies that cannot pay their bills and don't have enough cash flow to service their debt are going to get in a ton of trouble. And if they keep extending more and more loans, I guess you can drag it out longer. But um, I just don't. That's not a problem that really solves itself, and that's a different thing than the liquidity drop. Like, if we get another liquidity thing, it should happen soon. If we don't, then you switch the bear market outlook to solvency, which has to do with cash flow. Can people pay their debt? And companies that are struggling to pay their debt and they're burning their cash, and then they start issuing more shares to raise enough cash just to pay debt, that situation is really, really bad. And that's what we're already starting to see. Just now, we're starting to see that a switch from buybacks to share issuance and share dilution. And then on the liquidity front, I don't know if I mentioned that in this video, but I mean, what we had here before this is a very small issuance of bonds from the Treasury. So the government was not taking liquidity and using it for government spending. And then we had a flood of liquidity here, to fight against this huge contraction in the worldwide monetary system. Um, and then over the course of this, uh, especially towards the end of this move here, what we've had is a shift where the Fed is, I mean, the liquidity was nuts here and it's still high, but the Fed has been tapering down the the quantitative easing measures and the balance sheet expansion. So it's less liquidity every day from the Fed, but the bond issuance has gone like 4x, where the Treasury is taking liquidity out of the market and using it for government spending. So you have less liquidity from the Fed, plus the Treasury sucking up a whole bunch of that liquidity. So that's kind of a liquidity thing to watch, and the interest rates are at or near zero, and that's really the tricky thing that I've been trying to figure out, is the relationship of the stock movements in the U.S. Because liquidity is not only U.S. Like, this is a worldwide monetary system, and the rest of the world is in a depression. and the rest of the world is not bearish on their stock markets. But U.S. people are in a little bit of a different world because the U.S. government prints the dollars, and so the liquidity versus the U.S. stock market is a trickier puzzle to figure out. Yeah, so that's kind of the outlook. I think over probably the next 2 weeks or so is a look at what are these bonds going to do, what kind of interest rates are we going to actually see shaping up, because the yield curve started to steepen here pretty close to zero, and now, yeah, is the Treasury going to keep issuing more and more and more bonds now, and the Fed not going to print a bunch of money, in response to that? That'll be less liquidity. And that looks like what's happening right now is the government's reducing the liquidity, and the Fed's not responding yet. We'll see if the Fed does another big response, but they never came out and said they're doing some big response to like the government's bond issuance or something like that. I mean, they're like saying that they're keeping the banks functioning and responding to the virus and stuff like that. And so that's probably what the announcement would sound like. The next time they do it, they'll be like, "Oh yeah, we're responding to whatever stuff," but that's not really how it works. I mean, they're responding to the liquidity needs of the contraction in the international banking system, and responding to the government spending by Congress. That's what they always do, and that's how it works. And you don't get full access to that, but you can watch the Fed balance sheet, and you can watch the Treasury issuance. You get to see it occasionally, but yeah. But the last measures I saw for how many Treasury bonds that the government is issuing is like 4x from here to here. Like week over week, the bonds have gone 4x, and the Fed liquidity has decreased, not actually decreased, but the amount every week that they're expanding is decreasing, but it is decreasing relative to the Treasury bond issuance. And so I will stop talking about bonds and stuff like that. And this is not investment advice, and please hit the subscribe button. I have playlists with financial education videos, and yeah, let me know who's long vol and who is holding the TVIX, and how long you're holding it for, and if you understand how the compounding kind of fights against you the longer you hold a levered fund like that. And what do you guys think about actually shorting the SVXY instead of holding the TVIX? I'll chat with you guys in the comments, and happy trading.